You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. Welcome to the show, Keith.
Jim, thanks for having me on.
Well, I took a look at your website and I saw some interesting articles. How can oil stocks be both cheap and expensive?
Oh, well, that all depends, Jim, on what metric you look at. That's the big thing. There's lots of different ways to value these oil companies, and one of them is by their net asset value. So you take up the value of all the hardware they've got around, including what kind of reserves they've got in the ground, and you divide that over the number of shares. And right now, that valuation metric is showing oil stocks are fairly cheap. Most oil stocks trade right around their NAV, but now stocks are trading around 0.7 NAV. So each week, all the different brokerage firms put their numbers out that say what their valuations look like, and that's kind of what we're seeing is about 0.7. But on the cash flow multiple, these stocks are very expensive. What's happened is that, particularly on the natural gas side, and especially in Canada, you've got companies that would normally be trading at 7 or 8 times cash flow, trading at 18 times cash flow. And why that is because I think a couple of reasons. One is that the street is looking through this period of low oil prices and thinking, you know what, we think oil's going to go higher, so we're not going to bail on these stocks. And the other one is just that these management teams are able to kind of convince the street that they're going to be able to survive at these cash flows, which I'm not sure is correct, but that's the reasoning.
There was some good news in the BC natural gas field a couple of days ago. What happened?
Really, we're talking about the LNG game here, I think, and then
exactly.
That is the BC government seems to have got their royalty review ready to go, so that that's going to give a lot of certainty to the industry as to when they're starting to spend those billions of dollars on these big terminals, that they're going to have some cost certainty moving forward. And that's been the big thing, because certainly as oil and gas prices have come back, Jim, the economics of these big terminals are really in question. And of course, the big companies, they're looking out 20 to 40 years, so they understand there's going to be good times and bad times. But right now we're looking at a potentially protracted bad time for oil-related pricing. So these guys want to make sure that the royalty review that the BC government was doing is going to come up with something fair and reasonable. And so that's kind of what got announced today, and now it's going to go through the legislature, and hopefully we'll see some legislation that locks that in stone and gets some what they call final investment decisions, FIDs, turn positive and away to the races.
185,000 layoffs in the oil patch. How big of a blow is that to the economy?
Well, Jim, that's huge, and you think of what the spin-off's going to be on that, it's absolutely massive. So we are seeing a lot of layoffs, and certainly anybody who's not getting laid off is getting their wages reduced. So it's a fairly significant move that's happening here.
Canada has drilled 48% fewer wells than it did over the last 4 months compared to last year. Again, how big of a blow is that to the industry?
Well, not as big as you think, just because the amount of meters being drilled is increasing all the time. So the number of wells definitely is coming down. I wouldn't think the number of meters coming down is that much, but it'll be close. But certainly, again, Jim, what it means is that you are seeing at all the auction yards across Western Canada huge pieces of iron being put up for auction. People are raising cash wherever they can. Anybody who's got debt is just trying to put a new plan in place to make sure they can stay alive during all this time. So, because when the industry comes back, when pricing does come back, it is going to mean that a lot of these service companies aren't going to be able to respond as quickly as they want to, because they had to sell a lot of equipment just to stay alive during this time. So, drilling equipment, fracking equipment, all these companies here, it's going to present an interesting dilemma for the industry once higher prices return, to see how quickly they're going to be able to respond to that without near as much, equipment as they used to have.
With so many people laid off, obviously they're going to look for other employment. Does that create the possibility that there will be a lack of talent once the oil patch picks up again?
No, I don't think so. The oil patch pays really good money. So once things start to get rolling again, you'll see whereas right now you're hearing a big whoosh as everyone leaves, you'll hear a big sucking sound as everybody comes back in.
Has Alberta's new NDP Premier done anything interesting in the energy sector?
You know what? Rachel Notley has done what I would expect her to do. She's reaching out to the different energy associations. She's reaching out to the brokerage firms and having a lot of one-on-one meetings with sales desks and analysts groups to kind of tell everybody that you don't need to worry that much about what's going to be happening. And I think the consensus was, Jim, fairly quickly after she was elected, that it really wasn't going to have that big an impact on the oil patch. Certainly the oil sands and their cleanup crews might get a little busier, but generally speaking, from a cash grab money situation, most energy companies don't pay income tax. Yes, we should see a bit of an increase in royalties, but not so much. I don't think that it's going to scare anybody in the long term.
A lot of fear before, or I guess right after the election, but you don't think she's going to do anything scary, or it's yet to be seen.
I just think all the politicians in Alberta are different shades of blue. Like the NDP has the color orange as their kind of mascot color. I don't see that in Alberta. Certainly in BC, you did see quite a big change from the NDP's, what they promised in the election to what they did in the election when they were elected years ago. Alberta, I don't see that happening. It's a very homogeneous province. I'd be very surprised to see Rachel do anything silly out of the gate.
We'll have more with Keith Schaefer right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Keith Schaefer. The last energy land sale in BC brought in only $200,000. That wouldn't buy a doghouse in Vancouver. Why such a low price?
Well, right now, Jim, there's no cash flow in the oil patch. So, we're looking at most of our natural gas producers having a profit per barrel. That's called the net back of like $5 for the gas, and maybe as much as $20 for a good company, $20 a barrel. That compares to like $45 and $50 and $60 a barrel only a year and a half ago. So there literally is almost no free cash flow in the industry today. And everyone is reining in, and everyone has debt. Like, this industry operates on debt. So you're seeing a huge impact here on companies pulling back all new drilling. Nobody really needs any more land anyway. And they haven't for quite a few years because there was such a big land grab coming up to this year. But now it's just drill what we've got, don't need any new lands. And so it's a situation where anything new coming up just has so little interest.
A bit of a surprise in the natural gas field.
I would have to say the biggest surprise of the year, Jim. I was looking at the prices today here, and they touched just over $3 the last couple of trading days this week in the United States, and in Canada we're still holding in at $2.60, $2.70 a gigajoule, which is about $3 an MCF. And I would have thought gas would be $2 in the States and like $1.80 in Canada by now. I was probably the biggest bear in the street in the earlier part of this year because of the huge production gains coming out of the U.S. At one point in time this year, we were up about 7 billion cubic feet a day over last year. And so with all that gas coming on, I just thought, oh my God. And the other big bearish point too is that, the Marcellus formation in Pennsylvania, which is just the monster formation that has unbelievably impacted the natural gas market in North America and turned it upside down. They've got a lot of new pipelines coming out this year. And so all that super duper cheap gas should be able to spread throughout the rest of North America. So I figured as soon as that really cold February was over, we were going to see gas prices collapse. And they didn't. In fact, they've gone up. So I kind of put the research hat on and went around figuring out, well, why is that? And I came up with a couple different points. One is, with all that pullback in oil drilling, we're now seeing, there's a lot of gas associated with that. So probably about 10% of U.S. production is associated gas. And so that would be about 7 billion cubic feet a day. So if we're going to lose half that means we're going to lose about 3.5 billion cubic feet a day. Well, it just so happens that power demand is up about 3 billion cubic feet a day this year. So that is a 6 BCF a day swing, and so that's a lot. And so that has put a bit better bid under the natural gas market than I expected. And there's a couple other things going on. You know, the Marcellus has grown hugely. It's gone from like 2 billion cubic feet a day to about 18 or 19 billion cubic feet a day in the last 4 years. There's a growing consensus that that is going to peak this year. And now that's still a big number, obviously, 19 billion cubic feet a day. And the reality is that we should be able to keep it at that level because there's such a large backlog of wells in the Marcellus that haven't been brought online yet, probably about 1,000 or more. But that's not going to be good enough, Jim, because every other basin in the U.S. is in decline. So I think there's a good chance that Texas could drop a full 2 billion cubic feet a day this year because of their big drop in associated drilling. So it's more and more people are coming around to the idea that, you know what, if the Marcellus peaks, it doesn't need to go down for gas prices to go up. It just needs to stay flat because it's been the only real additional source of new natural gas in the U.S. for a few years.
Is that good news for gas producers in BC and Alberta?
Yes, but down the road. You know, I think we're going to see a big, if we do turn into gas bulls, you're going to see the U.S. guys turn first, and they still have so much gas. They really don't need our gas that much. So I don't see, given that we've got increasing production here in Canada for the first time in about 5 years, we're up 750 million cubic feet, 750 million cubic feet a day. I don't see our producers really getting that much love out of the. But if we get it, Jim, it's going to be later in the day. And there's a couple other things going on. You know, Mexican imports, of U.S. gas are up a little bit, probably an extra 300 million cubic feet a day than what was expected. That's about 10%. So yeah, so there is stuff happening in the world, and in the U.S. That's kind of bullish. But all these pieces, Jim, they're just mildly bullish. But I guess the truth is that when you start adding them all up, it turns into a much bigger picture. So that's kind of where we're at. We're seeing that all these little things that really on a absolute basis don't mean very much, but the market is saying, well, you know what? It adds up to enough that we're going to make sure that we have all the gas we need through the winter. And in fact, now what's interesting, Jim, is that even the futures prices for gas are quite a bit higher. They've moved up from $2.20 and $2.50 all the way up to over $3 an MCF now. So that means in the future, people are thinking it's going to be a big deal as well.
And what about decreasing political will to allow fracking?
Yeah, that is just the last thing on my worry list. There's so many jobs that have been created through fracking, and this administration would have done something about fracking long ago if they were really nervous about it. But there's no political will in Washington to reduce fracking in the United States.
Keith, thanks a lot for chatting with us.
Jim, thanks so much for having me on, and look forward to our chats.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, their website, oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.